You have almost all stocks in the green except for Apollo Hospitals, which is a tad in the red. So that's good going. The best of gains is coming for JSW Steel. Well, it usually happens when you're exiting the index. That's when all the selling has already happened and the stock begins to see a bit of short covering. Otherwise, metal stocks otherwise as well have been doing well. So I think the DGTR going in with some initial investigation on whether an anti-dumping duty is needed is casting a positive pall. The positivity is also then on NBFC stock, Shriram Finance doing well, and then that could be explained by the fact that we have a likelihood of a February rate cut if you looked at the statements coming in the MPC. Among the other stocks that are doing well, Trent, M&M, Bharti Airtel, Wipro, L&T, Axis Bank, many of the stocks that we did discuss. I think the IT stocks are a late recognition that Accenture gave us good news. So there's a bit of green over there, but actually green all over. So it is really a top-up, top-down purchase of the Nifty that we are seeing at this point in time.
Absolutely. Nice 200-point bounce. You haven't seen that in a while, given how weak the market has been. Do remember to take note of Reliance. Remember Jonathan Garner, the Morgan Stanley call, saying that refining is going to get much better and the company will see a pickup in its fortunes in 2025. There are a lot of refinery outages, so therefore that will all help boost GRMs in the core business, 1% up on Reliance Industries. The insurers are sulking because nothing came out of the GST meeting. Slight red, not too much, but about 0.5%, 0.25% decline on HDFC Life, ICICI Pru, Lombard, SBI Life, Max. All of the insurers are down because the wait for any kind of rate cut on health and life insurance, that continues. Just some more stocks to speak of. By the way, the midcap market is also quite healthy, in step with the large caps almost, with a 0.5% gain on the indices. I go back to India Cements, 8.5%. Again, just a reminder that the open offer that Ultratech is going to launch is going to be at 390 rupees. And now the deal has gotten cleared, so lots of excitement around India Cements. In fact, a lot of the other smaller cement stocks, look at Star Cement, look at Orient Cement, very interesting. Even Kalyani Steel, we just spoke to the management right now. They're hoping that even their products will be covered with the safeguard, investigation that's underway. So some of these material stocks doing quite well this morning.
Some more. So MobiKwik, one of the recent listings, is practically double now. 279 was the issue price, and now the stock is at 524, a good 7.5% up move. It's day 2 for IGI, International Gemological Institute, and it started off with strength, 4.5% gain. Across the board, steel-related names are higher. So, pull up a sale that's up close to about 2 to 3%. JSW Steel, 2.5%. JSPL also higher by 2.7%. Order wins are pushing up. JBM Auto. For JBM Auto, it's an 1,800 crore order win. And for Sterling and Wilson, it's a 1,200 crore order win. Vedanta is another one where the parent company has decided not to demerge the base metals business. So Vedanta has a green tick. Not by a whole lot, but Vedanta is up and about in trade. Sagility deserves mention for the last couple of days. It's been rising. Last week, Jefferies initiated coverage on Sagility. Target price set was 52 rupees. On the way down, you've got some insurance-related names, as Surbhi pointed out. So Star Health is down 2.5%. SBI Life, HDFC Life in the red. Siemens, after the 10% downtick, has lost some more ground, 2% gone on that. But on the whole, the opening has been strong, in line with the strength that we're seeing across the Asian market, about 3/4 of a percentage point higher on the Sensex and the Nifty, and a very strong advanced decline ratio.
Okay, all right. Let's just take final stock of prices before we move on. It's really metals all the way, and that trend is intact on the Nifty. JSW Steel, Tata Steel, Hindalco. Not only for the steel guys, obviously the safeguard duty is a point to note, but also remember internationally the dollar's finally taken a bit of a breather. So perhaps in the holiday shortened trade, some hopes and expectations that internationally as well you'll see some revival in prices. So sentiment rub off over there. And Reliance is gaining more ground now, about 1.5% up on Reliance. And the banks are absolutely in step with the Nifty, so they're helping stabilize things this morning. HDFC Bank, SBI, a lot of the biggies up about 0.7% to almost 1%. So nice green-looking screen for now.
Absolutely. I mean, at least it's holding up for the first 5 minutes. Let's keep our fingers crossed. And the entrant into the Sensex, Zomato, is now seeing red. As always happens, everyone's already bought into it. Today is the profit-taking day. And short covering, one can see on JSW Steel. There is the metal news, of course, or rather metal hopes. And as you move out of the index, all the selling is perhaps over, and JSW is in a spot of green. So it's kind of switching the colors, as it were. Well, it's time now for our special segment, Outlook 2025. How will Indian markets perform in the coming year, which is just about 8 days away? What are the growth headwinds? What will be the top stocks and sectors to look out for in 2025? To talk about all that, we have two special guests with us in the studio. Aditya Suresh, Managing Director, Head of India Research, and Sandeep Bhatia, Managing Director, Head of Equity India at Macquarie Capital, both of them. Sandeep and Aditya, thank you very much indeed for joining us.
Good morning.
Well, Sandeep, let me start with you. As your report says, the consumer has decided to take a nap, looks like. Not much consumption. Very nice phrase. But what's the sense? You think it's bottoming out, and as the government spends and the Rabi harvest comes in, would it be buy time in 2025? Consumption stocks.
So consumption has been weak, and that's something which has been seen in earnings. I would think that consumption should slowly inch up. There's not going to be a quick rebound. That doesn't happen, especially for the broad swath of consumption that happens in India. But definitely, this means that the worst is behind us. Whether to buy the stocks, I would think we should wait for longer correction, both in the market and for consumer stocks specifically, before we buy them. But the worst of consumption probably is behind us, and it's a slow uptick.
It's not yet buy the fear.
Yes.
Okay. Just to add to what Sandeep said, I think we think about consumer as three parts, right? The top end, I think the characterization is things are okay, but momentum is softening. I think the middle category is where there is a problem, and I think that problem may kind of persist depending on kind of incomes and inflation. Rural, I think, is an area where I think we are seeing at least some green shoots, right? So things have been kind of soft. Company commentary speaking a bit more optimistically. The data as well is starting to improve a little bit. So I think, in those three categories, within this top end still looks relatively better place, but in there, momentum is softening. But a lot is already in expectations. That's, I guess, a problem for these consumer stocks.
People will always argue on valuations, right? Sandeep, I remember you've been cautioning, on the markets for a while now in our previous conversations. In fact, I think the middle of November when we had you on, you were saying you wouldn't be surprised if you see another 10% downside from here. And in individual stocks, it's really played out. Beyond the consumer, like when you look at the year as a whole, the whole hope is on this government capex picking up, right? But beyond that, is there anything that can turn the tide?
What can turn the tide is that if India manages the Trump presidency well. India is one of the few countries which, besides the US and China, is entirely domestic driven. But for the first time, I would say, the way the world is positioned, the US is actually pivoting in a major way. The US has been the consumer of last resort. The growth model, which India did not implement in the 70s and thereafter, was export to the US, be allied to the US. And that has been a very slow and painful path for India to take. Even now, we are primarily a domestic-driven economy. But we are now definitely looking to be more closely connected with the US. And if the US pivots away from being the consumer of the last resort, then there is growth challenge for the rest of the world, and including India, especially where we are most exposed to, which is in IT services. H-1B visas could be something which the US government can take up. So all these issues, if Trump comes down with a sledgehammer on tariffs or on some policies which make it difficult for our businesses to operate, there could be a correction in the market. There would eventually be a reset, and Indian companies will come out stronger and better. But there would be definitely an impact on the markets.
But just to
one minute, with your permission, Aditya, you tell me. I would respect Victor Schwetz's a great deal. The Macquarie Capital thinker. What does he say about the global, fund movement? There is a point. Dollar cannot go on 108, 109. As well, yields in the US, the US stocks. When does he see the inflection point when the US exceptionalism will stop?
The short answer is in the short term, market does not see that inflection. The strong becomes stronger is kind of the mindset. Yeah, and that I guess is a problem, right? So the stronger dollar is going to be a broader problem for emerging market fund flows. Within that context, India has not seen any meaningful fund flows in the past 3 years and 4 years. So is that really going to be a tailwind here for markets for the next 12 months? We don't see that necessarily.
Okay, sorry, Surabhi.
No, so I was actually asking you something on similar lines, that in fact the fact that we've been more domestic driven, doesn't that actually help us and work in our favor in case we get this tariff blow? And while I take your point completely on the US being the consumer of last resort right now, it's doing so well, right? That's why the money is rushing back there. So again, what should we, beyond IT services, from the global arena, what should we be fearful of? I mean, on the flows point that Aditya made, you see any changes there at all?
So a strong US dollar is bad for all equity inflows into emerging markets as an asset class. The other thing that we have to be fearful of is how the geopolitics is shaping up. I've been saying that for almost 2 years now, that actually more than earnings, geopolitics is the driver for a lot of things which are happening, which have been broadly good for India. So if something happens in the neighborhood which puts India under any geopolitical pressure, then that could be something which we need to worry about. Not that I expect it to happen, but we have seen unexpected events happen all through 2024 and before.
So let's talk about what investors should do, right? You spoke about some headwinds. There are 5 of them which you've outlined, which will test the resilience of the domestic liquidity. But you still have some buy ideas. In this rich bazaar, bottom up, you still find 25 buy ideas. Can you talk a little bit about that?
So let me just go through that a little bit, right? So in that report, what we're basically saying is that there are these headwinds for us to kind of work through, as you kind of pointed out. But it's not to say that India as a market, we can't find bottom-up buy ideas. So within our coverage, there are these 20, 25 odd kind of ideas which we still find and we still like, and it's attractive. At a sector level, when I kind of aggregate up where we are a bit more optimistic, it ends up being we're far more optimistic on telecom and IT compared to the benchmark. We're a bit more optimistic on healthcare as a space. We end up being neutral on financials. We end up being meaningfully negative on consumer, right? That's kind of a key underweight here for us. Industrials is about kind of in line. So that's kind of the broad kind of flavor of kind of how we are positioned. We can touch on the specific stocks, but yeah, sector-wise, that's how we are positioned. But a lot of it is also down to what's already in earnings expectations. And the 2-year forward story, is that going to be lifted upward or downward? And that has a big influence on kind of what is mentioned.
Either of you can take this, but would you all prefer mid-caps? Because all the selling is coming by the FIs in the big ones. So even in pharma, for instance, would the preference be towards non-Nifty?
I think the general mindset, Latha, is more just specific and bottom-up rather than a general broad brush of mid-cap, large-cap. But you're completely correct that foreigners, as an example, the banks, that's been the biggest kind of overweight position. And despite the valuation support, there's more selling which is kind of coming through. Absolutely. So it's an interesting dynamic which is at play. But I wouldn't characterize as sell all mid-caps. I think there are quite a few kind of quality ideas within there which we like. Yeah.
Okay.
And to top it off, and this is something you mentioned in the report, there is, apart from the FPI selling, there is VC selling, there is MNC parent selling, there is Indian promoter selling. So just a sheer supply of paper. How much does that concern you folks? And I mean, we've seen this in the past. I don't know if this is the same again, that when you have this amount of paper hitting the market, usually coincides with a bit of a top. So on the market as a whole, what's the market call for 2025? And what about all this additional selling in India?
Yeah, so just on the supply of paper as well, it's clearly in response to the excess liquidity which is there in the market, right? Just to contextualize this again, domestic liquidity, even if you follow the NSE pulse, I mean, when you look at DII plus individuals, it's about $70 billion in this year, right? Which is a fairly large number. That's only the first 10, 11 months of the year. So there is more there with that. It's not been foreign. Now, when you think about the primary and secondary kind of supply, it's still behind this, right? So to the extent that this level of domestic liquidity holds, this pace of kind of primary and secondary activity can actually be absorbed, right? Now, having said that, I think the broader things which we think about is, in fact, just 2 points. One is that the average ticket size of these transactions down 75% in the past, say, 2 years. That, I think, is a red herring on its own. And point 2 is that only about, say, 5 or 10% of these proceeds is going to fund growth capex.
Absolutely. It's all people
Everything
cashing
else
out.
is luxury property, right? Or something else somewhere.
Yeah.
That is, again, a red herring. But I think the broader dynamic is that I think it's in response to these deep liquidity dynamics which have manifested itself. And as long as that holds, we could see a repeat of this next year as well, right?
It's all boiling down to domestic liquidity then.
Yeah.
Yes. So just to add to what he just mentioned, I would welcome the widening of the market in terms of the IPOs which are coming through. There are some good businesses which were not listed, which have been listed, and they will get, we'll see further additions. We also saw a process when the GDRs and ADRs were coming that we were exporting our markets out. That's not happening. So structurally, that's a good thing. What is, as he said, pointed out, is a worry figure. And someone I know has said that at the beginning of the bull market, the investors have the cash and the promoters have the vision. And now, at the end of the bull market, the promoters have the cash and the investors are left with the vision. So in the end, I think the way the IPO markets are happening with everyone cashing out, it's clearly that valuations are very rich and very and a good point to cash out. And therefore, this can continue as the liquidity flows can indicate. But in the end, it only points down to the underlying theme, which we've been saying for some time now, which the markets are expensive. Earnings has been slowing down. A lot needs to unfold in the first 2 months of next year. We need to see where the Trump presidency is headed. We need to see where India can position itself over the next 2 to 5 years before we see stabilization of the markets and valuations and an entry point emerge.
Okay, you have given us one big cue. Wait for the promoters to stop selling. That is an indication the market is not overvalued.
But has so many IPO KYCs. She's our IPO expert here. She'll tell us about the kind of money that's just
I have
right?
Rima's question for you. IT stocks, I mean, after Accenture told us, would it be a buy?
And especially when you said that IT is at risk because of global factors, but as a house, you are bullish on IT.
So I think it should be framed in the context of what's already in earnings expectations, right? And when you see IT sector, there has been a downdraft of earnings in the past, say 6 months, right? And so at least our analyst is far more optimistic about demand. And the call is that you're going to see revenue beat on the upside, plus there is marginal expansion. So he's selectively optimistic again on the IT space. It's not like we're going to buy the entire sector and buy all the large caps. So we do like a few mid caps, we like the TCS, HCL, these type of things, persistent in the mid caps. So yeah, but that's one area where we are a bit more optimistic relative to where expectations are at.
Okay, so that's IT. So let's recap. I mean, we've taken all the headwinds that you've played out on board. Apart from IT, where do you see relative safety? Or I mean, when you say you have to be buying when eventually there's a correction, time or price correction. So
I think banks are a good place.
Okay.
Banks' valuations are not as demanding. I think the other thing which anyone who's been long enough in the market realizes is that the banking sector was the Achilles heel of India. In the last 10 years, there's been significant positive structural improvement. In addition to the fact that the fisc of the center has definitely improved. In fact, I would think that other than that, people give a lot of importance to the China plus one factor, but these are the domestic factors, whether it's the Indian fisc, whether it's the banking sector, and also the relative political stability that India has seen, and therefore consistent policy direction in a broad sense, both for economics and for the foreign policy. All that has contributed to India emerging as an important pole in the emerging market universe. So that is something which I would think more than just China plus one or anything like that, and which is why even if there is some growth slowdown which is happening in the market, I would think that if these factors continue, India's markets may see corrections, but that would not mean that they would be very deep.
Okay, but would you expect earnings downgrades to continue for the next 2 quarters, and is it priced in? He spoke about growth slowdown.
No, so I think that's one thing which we would definitely want to continue to caution, that in the past 2 quarters, we've finally started seeing more misses than beats in estimates. The shape of the earnings graph for India has been a big support factor over the past 2 years, right, where our estimates have kept being revised upward with that markets were supported. I think that has to be reset. There has to be a reset, right? So expectations remain still far too optimistic. When you look at the kind of 2-year kind of growth outlook, it's still about 15% EPS growth. which is, I think, disconnected from kind of what we are seeing, at least on the bottom up.
And what should it be reset to, from 15%?
I think if it would be, even if we get 10 or 12, I think that'll be a good outcome.
And is that
But are you
priced in?
expecting that for FY26?
For FY26, yeah. So we are at between 10 to 12%. But even that, I think there is an element of optimism in those estimates already baked in. When I look at kind of what's happening on a quarterly basis and look at the trend there, it's not consistent with that outlook. So there is hope to get to that 10 to 12%.
No.
But it has the risk. There are
That means
downside risks to that.
another year of single-digit earnings growth can't be ruled out.
We would not rule that out.
Oh.
But then it's always been about a market where we cut, roll forward, and keep the faith in the two-year forward story, right? So the narrative about the growth outlook also matters.
Okay.
But for FY26, yeah, we are more in the camp of more
But how do you
downgrades.
hold the flag of, the India story with a high single-digit kind of earnings growth for the next 2 years?
So we are more in the camp that, as a market, we do pull back.
Yeah.
There,
How much?
there is a reset which is required. The how much is clearly a function of domestic liquidity. So why we are where we are as a market, a lot of it as a multiple as well, is driven by this domestic liquidity dynamics, right? So to the extent that the resilience of this liquidity is tested, then then the downside is probably going to be a bit more, a bit more profound.
Sandeep, you want to add a range to that? Last time you told us maybe 10%. Widely, I mean, wide range, perhaps for calendar year 25?
So I'm not in the camp that domestic liquidity can always be a savior. It can actually cushion the impact of earnings disappointment. So I would think that another 10% correction in the market in the first half of the year, depending upon what happens in terms of what Trump does. Actually, as I said in the very beginning, it actually is externally driven for a change in India, the market, rather than internally driven. But it would be something which if India sees a growth rebound coming through, which it can and which it should, that couldn't be easily be cushioned with domestic liquidity. So we have to see.
Your choice of stocks is all very much defensive. Look at that. Sun Pharma, Lupin, all the pharma stocks. And then you have TCS, HCL Tech, Birlasoft, all the tech stocks. Tech and pharma, classic defensives. You're not betting on the capex cycle. You're not betting on the L&T types. Don't see it on the anvil.
No, look, I think, again, it's got to be framed in the context of what's already in expectations, right? So industrials, when you look at what's in earnings expectations, there is a lot of growth which is already built into the L&T estimates,
price.
right? And so at best, we're meeting numbers. There is confidence on that theme. And I think this first half blip which we saw, we still think that the first half government capex kind of slowdown was more a blip. So we're still behind the theme in full. But I think it's more that bottom-up list again is more in terms of what's already in expectations and where there is a bit of upside in the multiple. L&T does feature in that list of kind of or within our top, say, 15 odd stocks in there. And that's more, but the proxy again is more about the confidence of the theme than it being about earnings being revised upward.
Yeah, fair enough. I mean, there's power grid. So you do have capex stocks. Yeah, sorry.
Okay, so just to try and be optimistic, though we have to be realists, and you've laid out all the concerns. But if one to just talk about the optimistic upside, the upside risks to a lot of the estimates you've sort of laid out, what could be the upside risk that perhaps stops this relentless FPI selling for one?
So I think 2025 is election light year. We just have Delhi in the beginning of next year, and then we have Bihar coming at the other end. I don't think it can throw up very negative surprises. People already have expectations on both elections. And then we have rest of the year to keep batting and hitting some 4s and 6s, as I would think. I think if Trump comes across and can not be so negative for India and for the rest of the world, he's a deal maker, and I would trust his instincts that he would actually be ready to make a deal with whoever decides to do that. We would have stability on the broad global macro. And if that happens, India's underlying growth story will re-emerge very quickly. By the second half of the year, most of it will be visible, and the markets will start. Even before the earnings come through, once we have stability on these fronts, the market can easily rally from the second half. So it's actually, my view is that the first quarter is very important. After that, we will know where we stand.
And in the emerging markets, where is it that Macquarie has the highest conviction in the first half and in
India.
India?
Yes.
Despite the FI
optimism at last.
But we have the Macquarie thinks that the US, India, and Japan, and as you said, in emerging markets, it's India.
It's India.
So these are the countries which are have the most degrees of freedom to deal with anything that's thrown at them.
Okay, let me push my luck then. Top 3 conviction calls in India.
I'm going to refrain from the stock ideas. That's there on the reports. It's probably flashing on the screen. But yeah, I mean, as a market, and to start towards Sandeep saying, I think the characterization is really about 2 steps forward, 1 step back. I think now the next 6-12 months about the 1 step back before you go 2 steps forward. Within that dynamic, our mindset is defensive. In that defensive construct, our positioning is in IT, pharma, and financials.
Okay.
IT, pharma, and financials. And
Financials.
hoping for a better second half of 2025. That's where some of the positives maybe
Maybe second quarter.
Maybe second quarter itself, so it's not that bad. Yes.
Good.
Nice.
So if we push you hard enough, we get an advancement. Thank you very much.
Thank you, gentlemen, and wish you a very, very happy 2025 to you, your teams, and of course, all your near India ones.
Happy holidays.
Happy holidays.
Thank you.
Thank you.
Thank you very much for joining in. So now let's focus on the diagnostic and the healthcare space. What are the sector growth expectations? Should we expect any price hikes? How will volumes shape up? To discuss all this and more, Ameera Shah, promoter and executive chairperson at Metropolis Health, is now joining in. Ameera, thank you very much for joining in. Give us the top 3 priorities for Metropolis for 2025. You just closed out last year with an acquisition of Core, which enhances your presence in oncology. Looking ahead at next year, the top 3 things that you're focusing on.
So we're very excited about 2025. I think, like you said, the top 3 priorities, and Core was our first move there. We'll continue to expand into the north and east of India. These are markets, while we may be number 3, number 4 in these markets, but we would certainly like to move ahead and become, significant leaders in the market. So we'll continue to sort of keep building market share in the north and the east of India. So that's certainly priority number 1. I think overall, with Core coming on board and cancer testing becoming a very prominent part of our portfolio, we will really expand into new kinds of testing that center around oncology and other specialty areas, and continue to build the specialty area in a very significant way as well. So I would say that's certainly number 2. And overall, I mean, I think the expansion of the network, we're currently in about 700 towns and cities. We do believe we'll get to 1,000 towns and cities next year with network expansion. And we would also like to continue to focus on the productivity of the network. So I think these 3 will continue to be the key KPIs, from a financial and a operational perspective. From a quality and a scientific perspective is obviously always staying ahead of the curve, being a pioneer in all kinds of new innovative testing, and ensuring that we continue to remain the most respected scientific brand in the country.
Okay, you actually touched on all the things I wanted to ask you about. So thanks for that overarching answer. But now for some details. After you all bought Core Diagnostics, your total amount of specialty percentage has jumped from, I believe, 37 to 41. Will that be a strategy you will pursue to increase the amount of specialty products? Any more M&A on the anvil? And, by the end of next year, what would the specialty contribution be?
So certainly, I mean, I think the idea of buying a specialty oncology player is to continue to grow that piece of it, and we'll continue to do that into next year as well. Core as a business has been growing at about 22% CAGR, which is not including COVID or any sort of one-time contracts. And we would obviously like to see that growth sustain or grow faster as we move forward. And obviously getting profit out of that acquisition is going to be Metropolis's cup of tea in terms of really executing any consolidation or operational synergies that we think are possible to be able to really make it into a profitable enterprise and that get that value bit into our books. So yes, I mean, I don't think we have a number in mind that we're going to take the specialty portfolio to, but we would certainly like to continue to see progress every year in the right direction.
Ameera, hi. Thank you for joining in, and season's greetings to you. I want to know something which has a bearing, I mean, both from a consumer standpoint and from the business standpoint, which is the competitive intensity and pricing. Typically, I think you folks take a price hike once every, 2 odd years to 3 years or so. There was a hike taken in January. Will you be looking or considering one again in 2025? And how intense is competition now?
Look, honestly, I think when new health tech players came in and started using pricing as a tool to try and acquire consumers, we always knew that that can work only as far as the wellness segment, where consumers are not sick and are therefore making a decision based on convenience and price. But frankly, on the illness side, which is 90% of the market, we don't find that consumers make a decision based on price, and that's the reason why your scientific edge, your trust, your capability to provide large test menu, all of those things matter much more than pricing. We had taken a price increase on B2B and B2C. The weighted average of it was about 3 to 4% in Jan 24. And while it was 6% on B2C, it was about 2-3% on B2B. So therefore, an average of about 3 to 4%. And I think in Jan 25, in 25, we will again consider whether we would like to do it or not. I don't think we have a decision yet, but it's certainly something that we are considering as we go along.
Consider it, and I know this is still under discussion, would it be similar to the quantum of hike taken in 24? If at all you go through it, what's the thought process right now?
No, probably not. It will probably be a little bit lesser than what we will go through in 24. Again, like I said, we don't have a decision on anything yet. But at this point of time, the way we usually look at it is that sort of every couple of years, if you're able to get sort of a 5% kind of a number going, then you're sort of in a reasonably okay shape. We would look at it, if anything, as a 2-year sort of plan rather than an annual plan. And if we have done something last year and we do a little bit more this year, but it's sort of the weighted average of it has to be sort of a 2-year.
Amira, just talking about that one point, that you want to expand from 700 towns currently to 1,000 towns by the end of next year, and focus on improving the productivity also along the way. How would you measure the productivity? What is it currently, and what is the KPI to measure it? What is the goal on that front? And secondly, as you expand into tier 2, tier 3 cities, how will it affect the kind of return or productivity? Because it appears that some of the tech-led players are gaining market share there and are pretty strong.
Not with my information. Actually, I think, like I said, that the sectors are quite specifically divided into more wellness and illness. So actually, if you see on the illness side, it's the incumbent players who are more brick and mortar. And of course, all of us are omni-channel now, so you really can't decide them as online player, as offline player anymore. Everybody is omni. We get 20% of our revenues from digital channels as well. But I think as you go deeper into the markets, your wellness component actually is not as high as the component of the cities, because the knowledge, the awareness that you need for wellness from the consumer side is much lesser in tier 2, tier 3 markets. And that's where illness testing actually is predominantly important. There, if you actually see, it's either the local brands or the national brands, which are in the top 3 players. We certainly don't see any of the original online players in the top 3 in these markets at all. So, I think from our perspective, when we look at productivity, you look at your collection center network, and usually there is a maturity stage for it. So it takes about 4 to 5 years for a collection center to get to a mature stage. So what we do is we do an aging analysis of all our centers, as we have been, scaling up our centers rather quickly in the last 7-8 years. And we look at an aging analysis, and we look at what the revenue per month is from a collection center based on the aging and where it should be. And then you keep sort of working to sort of get it to the level that you believe it should be benchmarked at. And that's how you sort of assess the productivity per center. You have to remember, you can have 10, 50, 100, 200 centers feeding a lab. So there is no limitation on the number of collection centers that you can set up that can actually be the spokes attached to a particular lab. But the labs also function in a 3 sort of guided structure, in our 3-tier structure in our company, where you have the satellite labs who do the top 100, 150 varieties of tests. And a collection center would send the sample there. Whatever can be done there would be done there. From there, it would go to a regional reference lab, which would do about 500 varieties of tests, which would usually be in a major city. And from those regional reference labs, we would go to the global reference lab, which is in Bombay, where we do 4,000 varieties of tests, if there is any test that needs to be done. But all of this logistics is at the back end. So from the patient and consumer perspective, they get all their reports, at one time with one sort of envelope, or on their email, without knowing sort of which lab it's being tested in. And that's really for us to manage at the back end.
Okay. Just some nitty-gritty numbers. Industry volumes are growing between 6 and 8%. What will yours be in FY26? And what will your margins?
So if you look at industry numbers growing, there's really no third-party data. You can only look at what the public companies are growing at. And what we are finding is amongst the public companies, we're probably the faster growing. We are at about 8-9% volume versus some of our peers are actually at 3 to 4% volume. So the range, is that wide at this point.
All right, Ameera, we'll leave the conversation here for now. If you don't speak again, wish you a very Merry Christmas, Happy New Year, and look forward to more conversations in the next year. Get into a break. On the other side, the management of Unimech Aerospace and Manufacturing, their 500 crore IPO opens for subscription today. We'll get chatting with the management. Welcome back. Unimech Aerospace IPO opens for subscription today. It's a 500 crore IPO, which comprises of 250 crore of a fresh issue and 250 crore of an offer for sale. The company has already raised 149 crore rupees via the anchor book. To talk more about the company, the IPO offering, Anil Kumar, Chairman, Managing Director, and Ram Krishnan Kamajhala, the whole-time Director and CFO of the company, are with us on the show now. Thank you very much for joining in. Mr. Kumar, first, if you could just tell us a little bit more about the company, what is it that you do and what is the opportunity? So as of last year, you were a 200 crore kind of a top-line company. What is the overall, total addressable market for the products that you manufacture?
Okay. So thank you for giving an opportunity in CNBC, and I'm Anil, Chief Executive and co-founder of Unimech Aerospace. So as Unimech, we have two offerings as manufacturer. One is aerospace toolings for airframe as well as aero engine segment, and precision components for aerospace defense and energy sectors. So we do high mix, low volume, complex assemblies in our factory. So that goes into aerospace and other sectors. So when it comes to kind of total as you see from offering, one is tooling, which is probably about more than 18-20 billion kind of an opportunity in terms of USD, and for precision component, it's a very massive opportunity, which we have kind of where we have kind of only scratched the surface, because this segment is an emerging segment for us. We started about 2.5 years ago, where manufacturing complex precision components as well as some sub-assemblies. So this is probably more than 150 billion kind of an opportunity, I guess, and it is only growing, especially considering a lot of promotion in India, make in India for the world on the defense and aerospace sectors.
Okay. Well, Mr. Ramakrishna, good morning, and thank you very much, both of you, for joining us. only half the money you're raising is going to be used by the company. The rest is an offer for sale. I mean, that 250 crore that you will get, what is the capex plan? You've raised your debt. Will you retire that 75 crore of debt? As well, will you be better off this year because you're largely exporting with the rupee, getting depreciating? Is 25 likely to be a better year for you in terms of revenue growth?
Yeah, sure. I think next year, definitely it's going to be better year in terms of the kind of growth opportunity what we see, and as well as it's helping. The money is also coming into place, and the capex expansion also happening. So the 250 CR, as you mentioned, the fresh issue is going to be utilized, for three purposes. The capex expansion is going to happen, where 80 crores and all, we are going to use it for the capex, and then working capital, objective we have. And yes, debt repayment also we have, as we have raised capex, in the first half of the year, and that is going to be repaid, once IPO money comes, So yeah, it's a kind of good considering the opportunity what we have, and it is completely aligned with the capex plan what we planned. It's definitely is going to be a good year for the coming year.
Mr. Ramakrishna, you said you all are a low volume, high value business, and we've seen your margins expand from 21% in FY22. You're already at 40% in the first half of the year. What led to that? Is there scope to expand margins? And also the margin difference between aero tooling, which is most of your revenues, and the new area that you've entered into, precision components?
Sure. So the segment what we have selected is high mix, high mix, high complex, and low volume category, which is a kind of a niche segment which many of the manufacturer in India, not focused. Even for that matter, I think China also never focused on this segment, which is a kind of complex by nature, and volume wise, it definitely is a kind of low kind of opportunity because it's a large assembly kind of activity. So by nature, this segment, tend to give more margin, and more so it is the aerospace sector. So, but yeah, this year, first half of the year, the margins are slightly better than last year. Having said that, I don't. I can't assure, it's going to be the same manner. But it's a kind of probably a mixed variation also could help us in the first half of the year, to make more margin. Having said that, the next couple of years, like the more focus is going to be on precision component as well. So precision component comparative to aero tooling, the margins are slightly lower than that. Because of slightly more volume business is that so we do see a slight drop in margins when compared to aero tooling, but while next 4 years 70% contribution of revenue comes from aero tooling and 30% only comes from the precision component. So yeah, the math works like that.
Okay, then why are you selling out, Mr. Anil Kumar? You're selling out 85 crore and Ramakrishna 45 crore. It's doing well, good margins, you're saying, even if slightly lower because of precision tools. Why are you selling out?
See, originally... Yeah.
So yes, Anilji.
Yes. So originally we didn't have, intention to kind of, sell it out because, the amount that we have to raise in the main board, there is a cap actually at either 10% of the equity or probably 400 crore if I'm not wrong. Okay. So where our fresh issue that we kind of forecasted came up to only 250 crore. Then the remaining amount, if you have to kind of go up to 10% of dilution. So that can only be accommodated in the OFS. So, though it's not very lucrative for us, considering the growth in the future, but we didn't have any other way.
Okay. Mr. Kumar, what will the contribution of precision components rise to, and what is it currently?
So precision components is about 15 to 20% currently, in the company, approximately, and then it kind of goes up to 30-35% in the coming years.
Coming in 3 years, 5 years?
Yes, 3 to 4 years.
3 to 4 years. And this capex that you're raising some money which will be used for capex. When will that come on stream? And what will be the incremental revenue because of this? And is there a utilization number for you? What's the need for the capex?
Want to take up, Ram?
Yeah, sure. The capex, there are three, phases, I would say, the first phase already in H1, is already happened, maybe a couple of weeks or a month ago, we already some capex already come. And the next phase of capex, post IPO money comes, so once we pay the money, by before March, next phase of capex is going to be infused, or is going to be, come in. The next year the balance capex is coming. So in terms of revenue linking, if you see, while I can't give any number in future, but I can give an indication that the revenue per month revenue kind of thing, is definitely going to increase significantly as the first half of the year, capex is already infused, which is a kind of one-time, capex increase, compared to previous one. And then the coming capex, which is going to be before March, which comes, so that is going to be almost 1.2 times, kind of capex, addition is going to happen, and the balance is going to come up, some portion is going to come up the next year. So we would definitely see kind of 2 to 2.5 times kind of, monthly revenue growth, or kind of revenue growth, from that perspective, because the capex expansion is 2 to 2.5 times, is going to happen in 12 to 15 months time.
Okay, that sounds very impressive. And I think investors will be very glad to hear that you are selling it as a heart wrench, because the rules require that at least 10% have to be listed in the first round. That will be, of course, a positive that you really want to stick with your company. All the very best for the year 2025 and for your IPO as well, Mr. Anil Kumar and Mr. Ramakrishna.
Thank you. Thank you very much.
Well, that's the word from the IPO. So the barrage isn't stopping, and this looks like one where the promoters want to stick with the company and are only selling out because of the SEBI listing rules, the minimum public shareholding rules. With that, let's shift our gaze back to the markets. At the moment, the green is mostly held except for the mid-cap stocks, which of course did not lose as much, so one can understand the profit taking coming there. The fact that the green has held on in Sensex and Nifty is a bit of a hope as well, 1% higher on the bank Nifty. Let's invite Mitesh Thakkar to tell us what he would do after the first hour of trading. Good morning again, Mitesh. What's the strategy now, Nifty and stocks?
Good morning, Lata. So, while we have had a gap up, it's about 150 points higher, 170 points higher, but there's no sign of reversal as yet. So I'm still waiting it out in case we get a negative signal. Then we'll look at doing some bearish strategies via buying put options and selling out of the money put options. But till then, I think we're holding our horses. But on the stock side, again, it's a slightly negative kind of a trade which I have. Hudco is breaking down today, despite the fact that market is up. Hudco is down about 1.75%. So sell here with the stop just about range high of 244. Keep the stop at maybe 245. Look for a target of around 220, 2 to about 221 on the downside. And the other one is Kalyan Jewelers. Disclaimer that I have some very small positions over here, but here the breakout comes in below 718, 717. So it's trading at about 722. So sell below 718, keep a stop at about 730. Look for targets in 690.
Mitesh, very quickly, are you disappointed that the mid-cap index has given up its morning gains? The small-cap index is down 0.5%?
Not really, because the structure is in weak. We were oversold, no doubt, so there could be this bounce back. Might have a bit more strength, a few more hours to try and attempt. But till we get a move beyond 24,000 and 24,150 zones, I don't think there's a bigger reversal happening. So maybe a few days of pullback and choppy activity, but I think on higher levels, on rallies, I would want to still explore more of shorting opportunities.
Okay, thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned. Welcome back. Let's talk commodities now. And Manisha is now joining in. Manisha.
Well, thank you for that, Rima. I'm looking at an asset class which doesn't take a holiday, works 24/7. It's not going to be off even during Christmas and New Year's. And we've seen that happen in various previous decades as well. Well, I'm talking about cryptocurrencies right now. One of the assets which also has done very strong in sense of returns in this year. Talk about Bitcoin, and we've seen an all-time high of 108,000 on December 17th. It's trading around 95, 96,000 right now. But even with those kind of gains, it is 145% on the higher side in this year until now. Well, there are various reasons on why the cryptocurrencies have surged, but Bitcoin, which is the number one and has the largest market cap within the sector as well, is gained because of Bitcoin halving, which happens every 4 years. And every Bitcoin halving year, every fourth year, you will see prices continue to run up. It was in the month of January 2024 that we saw approval of Bitcoin ETF come in, and then subsequently Ethereum ETF as well. And we've seen billions of dollars come in for this. And because of that, you have seen institutional adoption due to regulated and accessible framework. So major names, funds, mutual funds actually have started giving their clients a way to invest into cryptocurrencies. Also, when you look at the institutional investors, they now own nearly 20% of all Bitcoin ETFs traded in US. So that would tell you on the kind of volumes that we seem to be looking at here. Well, if you look at the numbers as well, 2024 also had its bits of ups and downs here. If you look at the crypto frauds, while 2022 was 3.7 billion and last year was really high, this year as well you have seen $2.3 billion of frauds, rug pulls happen into the market. For 2024, the major names that you saw were Wazirex, Radiant Capital and DMM Bitcoin, where you saw tragedies happening. Well, the markets also are looking at 60% of tokens that were launched being malicious in 2024. Of this, 27% also faced rug pulls. And then 10 meme coins actually make up for $1 billion of market cap. So this is all that money that perhaps seems to be playing on whim right now. But 2025, and the markets do believe that it could be a stronger year going forward. One, because the US president-elect is a pro-crypto stance there. The other thing is that there is an open discussion now about using Bitcoin as a potential tool to repay US debt as well. That has been another reason that took the prices much on the higher side. And then there are various countries which are adding Bitcoin within their reserves as well. After El Salvador, we've seen Bhutan do it. Tonga, Paraguay and Panama also seem to be considering adopting Bitcoin as a legal tender. Well, going forward, it's going to be about wider adoption of real-world assets that could be supportive for this technology. And then there are 10 ETF applications which could also be coming up for review from CEC, and these come in from Solana, XRP, etc. So 2025, especially the first quarter of the next year, could be bringing in a lot in sense of positivity for the cryptocurrencies there. When it comes to Bitcoin, while we already have done 100,000 on the higher side, but 2025 promises to see much higher numbers there. Well, Tim Draper, for one, says 250,000 by the end of this year. Standard Chartered has been quite bullish on Bitcoin, 200,000 from them. Bernstein has put 200,000 off a level as well. And Investing Heaven talks about a big range. Of course, that is what comes in with volatility in sense of cryptocurrencies, 75 to 170 on the higher side as well. So much higher gains continuing for 2025 is the belief as of now.
My God, that's mouth-watering. Huge gains. I mean, 250,000. What does that mean in terms of taking away money from other markets? Thank you very much, Manisha, for that very interesting analysis of what might happen to the market that never sleeps, cryptos. Time now for a break. And on the other side, it's our special segment. It's the economy. I will be connecting with B. Prasanna, the head of global markets at ICICI Bank, to discuss the MPC minutes, the soaring US yields, the rising US dollar, and all that, how it impacts India. Welcome back. Let's now talk about the root of the problem of falling equities. The root of the problem is rising US dollar and US yields and the consequent fleeing of investors from our markets to the US. Also, we need to understand why the big private banks are higher today. Among the leading gainers in the Nifty are HDFC Bank and ICICI Bank. Are bankers reading the MPC minutes that came out on Friday to mean that the Reserve Bank will continue to keep the market supplied with plentiful liquidity? Is that a positive take for banks? For all these questions, I am joined by B. Prasanna, the head of Global Markets Group at ICICI Bank. Prasanna, good morning and thank you very much for sparing time for us. First, how have you read the MPC minutes? Is there something positive for banks here?
So I think, Lata, the minutes can be classified as a dovish set of minutes, not least because of the fact that there were anyway two external members who dissented and who voted for a rate cut. And if you look at their minutes, it seems to indicate that they will probably vote for a cut in Feb as well. Beyond that, if you look at the persons who actually held the rates amongst the external members, he's also spoken about the need to spur growth and the fact that it was a very close call. So it looks like the third external member is also looking very close to flip around to maybe a rate cut in February. The interesting thing is what's going to happen to the RBI members. And even amongst the RBI members, at least as far as the policies, the previous minutes are concerned, you had one member really talking about the need to cut rates on I mean, you need to pivot at the right time and you need to cut rates as we go ahead if inflation comes down. Actually, both the governor and the deputy governor are not going to be there. The ex-governor and the deputy governor are not going to be there for the next time around. So it's a big call as to what they are going to be, the new members are going to be saying. So net, I would say that the minutes was dovish, but a lot of what is happening in the market today, Lata, is actually happened post the policies, actually happened over the Fed meeting, over what's happened over the last week. Maybe we can discuss about that.
Okay. Yeah, of course. I don't think the new governor will want to take on a situation where all the three external members are voting against what the Reserve Bank is saying and he has to use a casting vote. I don't think he will want that to be his maiden shot. In any case, before I come to the events, the inflation number that came in a little more benign than the market expected in the United States. A word on how do you see liquidity in the Indian market? I mean, like I said, HDFC Bank, ICICI Bank are all higher today. In fact, bank index is the best performing index at 1.2% higher compared to any other sector. Are you all sensing that liquidity will be plentiful? Because a rate cut is actually banked negative in the initial stages. So what are you drawing positive?
So, Lata, I will not comment about the stock prices and its impact and what happens to ICICI Bank stock price. I'll stay away from that. But from a system perspective, I think liquidity is not looking too good, Lata, frankly. I think the CRR cut, while infusing liquidity, kind of was only offsetting the kind of liquidity tightness that have happened over the last 2 months or so. In fact, in the last 2 months, you have seen core liquidity drop from around 4 lakh crores to something around 65,000 crores as we speak. And this is due to a combination of FPI outflows, more than 2.5 lakh crores. Then there is a redemption of government bonds, and then there is CIC leakage. So the reduction in liquidity, core liquidity, has already happened, and RBI is partially offsetting it by inflows of liquidity, CRR cut. Going forward also, unfortunately, the currency leakage is only going to increase in Q4 because that's a time when typically around 1.25 to 1.5 lakh crores of cash goes out of the system. So from that perspective, and even if you assume FPI flows is not an outflow, and even if they remain neutral, it basically means that the core liquidity will be down to something like a flat number to around zero. By end of March, even after you take into account the CRR cut that has been infused. So net, I think the RBI has started a process of liquidity infusion, and we feel that if the FPI outflow or even if FPI inflows do not happen, then we are pretty sure that we are going to see more liquidity action from the Reserve Bank. I think the key question is what kind of actions are they going to take?
That was going to be my next question.
Yeah, so I think for short-term frictional liquidity issues, primarily led by government balances and government spending and all that, I think they'll be using VRRs and maybe VRRR sometimes to suck out and VRRs to infuse. But from a more fundamental perspective, I think core liquidity can be done only through expansion of RBI's balance sheet. So I think it'll be a combination of We feel it will be a combination of open market purchases primarily. Also bear in mind that in this year, if you see, RBI's balance sheet on the domestic side has also come down by around 90,000 crores, which is the bonds which are held by the Reserve Bank, which matured in its balance sheet. So even from a justification perspective, whether they should be doing it or not, I think RBI will not have a problem in doing an RBI open market operation, at least to the extent of 90,000 crores. They're just giving back what they took out in this year. And also bear in mind that they have actually changed their stance from a withdrawal of accommodation to at least a neutral stance last policy, which basically means that infusing liquidity is not against their stated stance. So either which way you look at it, liquidity is getting tighter, RBI stance has changed, and RBI has withdrawn liquidity from the bond market in the the first 6 months of this year. It looks like open market operations will come in, but I'm sure RBI will have to think it through and will take some little bit of time to, democratize it within the system and then try and, start the operations.
Now, I take your point. One of their biggest problems, as I understand from sources, is that, already the difference between the repo rate and the 10-year is barely 25, 26 basis points. So if you go and buy the 10-year, you're reducing that space even more. That's also a concern. But anyway, I want to get to the rupee and the currency. That small PCE inflation number coming a little lower than what the market expected, though higher than October. November inflation is higher than October, but lower than market expectation in the US. Does it mean that we are 108 is a topish? What are your thoughts on dollar index and rupee?
So I think, Lata, if you really look at the last 2 months, dollar index has gone from 100.5 around about to 108. So you can say that it's kind of, played out a really long trade and it's kind of getting into topish territory. But more than taking a call on levels, I think we would need to take a call on what are the events which are getting lined up and what is the direction. If you really see, two things which has happened in the last 2 months is one is, of course, the Trump trade, which came in before he got elected, then the Trump election, which happened, leading to a lot of dollar strength. And then you see very recently the fact that the Fed has actually kind of reflipped around to I wouldn't say a tightening stance, but a more hawkish stance. What you got last week was a very hawkish cut. And while the market was never believing in the first place that the Fed will go and cut for 425 basis points next year, they were more willing to believe it will be between 2 and 3. The Fed went the other way and actually cut down the number of rate cuts from 4 to 2, which I thought was a little bit more than what market expected. And now the market has actually gone the other way by actually expecting only 1.5 cuts next entire calendar year. So I would actually say that this trade of the Trump trade, as we call it, which is a strong dollar, strong US equity, higher bond yields, and weak emerging market currencies, this has been playing out. It is close to some kind of a reversal, but at what level it will reverse, we don't know. And the fact that in January, we still have the actual presidency happening. We also don't know to what extent the president is going to use all these tactics as a transactional kind of a negotiating tool, and what extent does he really do a 60% tariff on Chinese imports, in which case the yuan will have to depreciate much more. So these are the things which we need to watch out for. So I am wary of taking a level-based call and saying that, okay, it has appreciated too much, so the dollar will have to go back. I would much rather look for signals in terms of what's going to happen from the presidency side. But we also have a view that I think the Fed has gone much more hawkish than what is possibly going to transpire next year. We do feel that they might be able to cut 2 to 3 cuts of 50 to 75 basis points next year. So at some level, this trade would have played out and the reversal will happen. At what time and which level, we wouldn't know.
But nevertheless, I'm going to ask you levels. One that, from an investor point of view, if I hold on to dollars, the dollar is buying more, their stocks are rising, and they're giving me very good yields. It is exactly the opposite when you're holding an emerging market currency. Their stocks are falling, and the currency itself will buy less. It's weakening. Now, therefore, does this curb how much the Reserve Bank can cut? Will it be a very shallow cutting cycle? What is your timetable and number of cuts from the Reserve Bank as of now? And what's your year-end rupee forecast for 2025? 2% lower, 1.5%, something?
So Lata, I think first of all, I think what RBI rate cuts or lack of a cut does to the US dollar territory globally, it doesn't do anything at all. So that's the first point. But coming from an INR perspective and from the central bank policy perspective, since the fact is that dollar return is the maximum for international investors, and the only game in town in the last 2 months has been holding dollars. And if you look at a longer term return perspective also, US dollar return has outbeaten every other currency return. And why would people internationally hold on to an emerging market asset if they are not getting a risk adjusted return for that? So that's the core of the problem. And the problem is leading to a lot of outflows. So in this kind of a scenario, frankly, I would say that the RBI normally wouldn't be thinking in terms of cutting rates. They should actually be thinking in terms of keeping the rates on hold. But then we also know that RBI looks at domestic factors more for policy making. So if they do feel that going forward growth, there is going to be a downward estimate of their growth projection, and if they feel that the inflation number for December comes a little lower than what they have assumed in their trajectory, they can always make a case for expected inflation coming to 4% and hence, go and cut. So I think that's where we are on the rate cutting cycle. So February is live, but I would say that odds of a Feb cut is reduced. So in between Feb and April, we'll probably get a cut if inflation behaves itself. Now, I think, and so your question, Lata?
Number of cuts and rupee range.
Yeah, so I think we think it's a 50 basis point shallow rate cut cycle, which is 2 25 basis point rate cuts. And the rupee range is we have to prepare ourselves for a depreciating rupee. We do think that it's going to go to around 85.5 by end of this financial year and possibly towards 86 or 86.5 towards December. And of course, there will be periods when the dollar will reverse its strength globally because it has moved a lot, and then you would see a lot of bullishness in emerging markets. But at that time, RBI will be intervening to protect the rupee from appreciating much because they have to recoup all the reserves that they have lost.
Fair.
So the view is appreciation limited because RBI will be there, and depreciation, they have to let it go as yuan and other currencies depreciate.
Fair point. Thank you very much. You've given us some markers in the sand. Thank you very much indeed. And if we don't meet you on air, have a great 2025. Well, the market is having a good, first day of the last week of 2024. The Asian indexes, topics, KOSPI, all up between 0.7 and 1.7 for the KOSPI. Indian markets shoulder to shoulder, 0.7 higher on the Nifty and 1.2, 1.3 higher on the Bank Nifty. We are shoulder to shoulder in terms of gains. Fingers crossed on whether the recovery will keep the pace. Up on Bazaar, chart past.